So I am sitting here with Carl Richards, and I think he's better maybe known as Behavior Gap. Well, I'm not sitting here. He's halfway around the world in the middle of Utah. So here it's evening, there's morning. Good morning, Carl.
Good evening to you.
So I reached out to you on Twitter. This is kind of embarrassing because I've known about you for a very long time, but I didn't realize exactly who you were. And I started reading up on you, and my first reaction was, I have to sit down and talk to you. So can you just, for the people that might know your name, which has been seen globally, that but might not know you as a person, can you give some kind of brief introduction?
Yeah, I mean, it might be helpful just to start a ways back. Right out of co when I was in college, I applied for a job. I came home one day and my wife had found a job that we thought was a security guard job. So I thought, well, wow, what a great flexible way to work my way through college. So I went to apply for the security job, and I got halfway through the interview, and they hadn't asked me anything about my self-defense skills or kung fu or
No.
anything. And it turns out it was a securities job. So I ended up getting the job somehow, and that's how I ended up in the industry. And from there, I was a financial advisor at a big brokerage firm that's probably known globally. And I found myself in these meetings with, as probably anybody in this industry has found themselves in a meeting with a client trying to make a really important decision, and they just had this blank stare on their face, like they weren't understanding anything I was saying. So I jumped up and drew something, very simple because I have no art background. A series of boxes or circles trying to explain this concept, and they understood it. And so from there, I started drawing these things more regularly. And one thing led to another, and I've been doing these sort of weekly, we call them Sharpie drawings or sketches for the New York Times once a week, with the big goal being trying to just help people understand this big complex thing that we call money and help them make these decisions in a more informed way. And I guess also to simplify this process for people.
So I'm showing one of your images now on screen. I don't know if you can see it,
Yeah, I
Carl.
can.
I just love there's a specific one that I want to point out that I really like. I've just uploaded it, but all of them are really good. What's your first image? I suspect that this could have been your first image.
Yeah, that was the first. That was an attempt to really describe often we think as investors and particularly the advice industry. Yeah, there's an early version of it with just the pen.
Yeah.
Often we think as investors, our goal is to find the best investment, right? So if we had the ability to draw a circle above that, above the bar that says investment return, we're always trying to find the stuff above it, right?
Yeah.
Alpha, we call it, the best investment. And often that search, and it's well intentioned, it's what we think is our job. That search leads us to behavior, and I certainly go into it in more detail, but it leads us to behavior that results in us underperforming our own investments. And so that image was just an attempt to draw to explain that there is a difference between an investment return and an investor return. And unfortunately, the data is pretty clear on this. Investors almost always underperform investments. An average mutual fund, for instance, the average investor got a return that was under the average mutual fund, and that's a travesty, right? We That's just purely due to poor behavior.
So if you're gonna break it down, do you subscribe to this for, forgive me for if I don't know your specific advice, but there's a lot of these whole like this new ETF heavy focus where you choose simple, like rather simple investments and low cost investments. Is that what you're advising, or do you have some other model?
Yeah, no, I think, look, the actual investments that we use are the least important part of the decision. The stuff that has to happen before that is we got to identify well, it sounds funny, but most of us has to have to start by figuring out where we are today. And I used to think that was the easy part, but most people, and this isn't just a problem. And I've been to Europe 5 or 6 times this last 12 months, South Africa, Australia. It's not an American problem. It's not a European problem. It's a human problem. Most of us don't know where we are today. And by that, I just mean, like, what are your assets and liabilities? Like, build a simple personal balance sheet. Once we know where we are today, then we have to take a guess at where we want to go, right? So those are called goals. And most of the time people don't do that because the last thing we want to think about is 20 years from now. We're not exactly sure what we're going to be doing next week. But we have to make some guess, right? So if we have where we are today and we have an idea of where we want to go, then we build an investment plan that will give us the greatest chance of getting there. And then after we have that investment plan built, we go in and find specific investments to populate that plan. Now, to answer your question, I think the best specific investments are low cost and broadly diversified.
Okay.
Instead of trying to make bets on specific stocks or specific asset classes or any tactical asset allocation strategies, buy low cost diversified funds, something like an index fund, and hold on to it for a long, long time.
So when you say, do you like index funds better than, let's say, ETFs?
Well, again, I think when we use the term ETFs, it's kind of important to understand that an ETF versus an open-ended, what we'd refer to as a mutual fund, is almost just a wrapper. The underlying strategy of being passive. So I can buy an index fund in an ETF wrapper, or I can buy an index in a mutual fund wrapper, right?
Yeah.
So there are some differences. Obviously, ETFs trade all the time. I don't really think I care much about that. The important thing is whatever wrapper you're buying it in, we want it to be low cost and broadly diversified.
Yes.
That make sense?
Yes.
Yeah.
So no, because this is kind of the new breed of financial advisors. You mentioned previously we talked about that. Is the number correct that there's? I'm almost scared, like fearful to mention that number because it's so big. But how many financial advisors are there in the U.S. or?
Oh, it would depend on how you define it. I mean, I know we're talking a couple 100,000, right?
Is it
Like,
really?
I know there's one email list that claims to have 400,000 financial
Yeah, but
advisors.
that's the number. I didn't want to quote it unless
Yeah,
you did,
yeah,
unless it's some kind of a secret from someone else. But
yeah, I know.
it's an incredible number. And do you think that this is kind of a over, sort of an over focused market that it's a reason that there's 400,000 people just skimming the top.
Yeah, I think that the real dilemma, and I want to be super clear about this. Like, I actually think that there's this. I refer to it as the secret society of real financial advisors. Um, I'm sort of launching this thing that tongue in cheek, I refer to as the International Guild of Real Financial Advisors. Among that population, this huge population of people that refer to themselves as financial advisors, there are people who are nothing more than, that would be shoe salespeople if they weren't, or used car salesmen if they weren't selling financial advice. They're just salespeople.
Yeah.
Now, how to identify them? I mean, that's a real challenge. But among that huge group, there is a group of people who treat this as a profession. People who feel strongly about their fiduciary duty. People who go the extra mile to make sure that any conflicts are discussed and open and talked about. Any conflicts of interest. People who are really transparent about the fees that they charge. Not only the fees that they charge their clients, but they're also really transparent about the compensation they receive. And those can be two different things.
Yes.
And so, yeah, I think there is I don't know if new breed is the right term because they've been around a long time, but I think there's a growing awareness that there are actually real financial advisors out there as opposed to folks that you're just scared are going to try and sell you something.
Yeah. And I mean, I have quite a bit of familiarity with this industry, and what you're saying now is quite correct. I think the sales focus is unbelievable. And I recently made a sort of a new friend, I guess. That's a 22-year-old girl who I don't know her well, but I was so surprised when she said, "Oh yeah, I'm a financial advisor." It's like, Wait, what?
Yeah.
You're a 22-year-old, recently graduated something, and so what do you advise? Oh no, I'm in a bank and giving like basic advice, and you can kind of see that conversation. I mean, how can she possibly give advice? And you see that in brokerages, and you see that these like recently graduated people, how can you possibly give advice when you haven't lived? Like they're giving life advice when you haven't lived.
Yeah. Yeah, and I mean, I struggle with that because I was once a young advisor and I thought I was pretty good. But I think you're right. There's something that comes with having been through. I mean, I feel my advice to people now is I don't know that it's dramatically different, but it certainly was reinforced by going through what we went through in 2008, 2009. My advice is different than it was before that experience. And having lived through that has certainly informed the way I view my advice. So, the good news is young advisors have had a pretty amazing start. I mean, if you've been in the business 10 years, you've lived through, if you've been in the business 5 years, you've lived through some pretty amazing stuff.
Yeah.
And so I don't know, age is important. I also think the experience is important. I also think the area of the business. You can you can call yourself a financial advisor from like the growing number of financial advisors that would probably be would be better referenced as financial planners that are coming from the planning side. And so understanding where your advice is coming from and what those conflicts of interest are really, really important.
So let's take one, possibly the most surprising photo or the most surprising art you've created. It's on. That's why I wanted to ask you specifically about ETFs, because I had to re-look at that after what you said about ETFs. Um, Let me bring that up on my screen here. One second. So it's like literally on the back of a napkin. Exchange
Right.
traded funds plus your money is not equal a silver bullet. Can you say like in terms of the activity in ETFs now, uh, and how do you perceive this to be in your like with your perspective on investment?
Yeah, I just think that image was generated by just the number of kind of stories in the media and a bunch of conversations I was having with people that were like, "Oh, exchange traded funds, this is great," and 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 what's not really clear is the term exchange traded fund is really just a wrapper. Meaning it's almost just the container that houses the investment strategy. So it's not like it's new necessarily. What we're not really concerned all that much. I mean, sure, there are some specific benefits to ETFs versus mutual funds. I mean, and one of the benefits is always people have said, oh, it's driven down costs. Well, that's not necessarily. I mean, actually, yeah, it has had an impact of driving down costs um, in parts of the industry. But there have been really low cost index mutual funds for a long time, long before exchange trade funds. So, another benefit that people always talk about is, well, I can trade. It's actively traded. Well, I mean, unless you're somebody who thinks they're a hedge fund manager and you're actively trading, who cares, right? Like if I'm buying long-term investments, I don't really care if I can sell it every second versus a traditional mutual fund sells at the end of every day.
Yes.
So, daily liquidity versus second liquidity didn't matter really that much. So all I was trying to help people understand is exchange traded funds aren't, the term ETF isn't necessarily what's important unless you're a really active trader, which I would say, good luck to you anyway. But the term isn't important. What's important is underneath it, what's the strategy? You can have an actively managed, heavy leveraged ETF, or you could have a plain vanilla S&P 500 index ETF. They're both ETFs, but dramatically different. So that's all I was saying is don't think ETFs are some sort of silver bullet. It's not like you just solve the world's problems. It's the same thing, just a different wrapper.
Yes. So that's interesting because I never actually thought about how diverse how diverse the market has been previously. But you're absolutely right. I mean, these instruments have been around forever, and it's been a particularly good time to work with this in the last, let's say, decade, where the 60/40 the 60/40 bond equity split has worked terrifically. But my question is, what if this stops? We've gone through one of the most extreme changes in sort of the way a market works, and we've had this enormous like injection of liquidity. So it's not infeasible that bonds and stocks could drop at the same time. I mean, it's my
Sure.
favorite questions to a guy like you. How do you approach this?
Yeah, so I mean, that's a great question. It's interesting to think about, right? And I think about this a lot. I mean, the reason you get paid more, okay, all we're really interested in, at least the people that take this seriously, at least in my mind, all we're really interested in is figuring out how to build a portfolio of assets that will have the greatest likelihood of helping you reach your goals. Now, when we build that portfolio, we want to make sure that we're only taking risks that we get compensated for. Okay, and it turns out that historically you get paid a little bit more for owning stocks than you do for owning bonds, and you get paid a little bit more for owning bonds than you do for sitting in cash. You know, that's probably everybody understands that. And over time, stocks do a little bit better than bonds. Bonds do better than cash. Now, why do stocks do better? Well, because they represent risk. Now, that risk shows up at least when you're broadly diversified, right? Again, if you're like an individual trader and you're buying individual stocks, all bets are off, right? I mean, that risk could show up, you know, if you're in Tyco years ago, right? That risk could show up in the form of fraud. You know, that's individual stock risk. That's not a risk you get compensated for traditionally. So if you're broadly diversified, the risk shows up in the form of what we refer to as volatility. I mean, there are periods of time when the market goes up and down. Now, the dilemma, of course, is we historically have defined the periods of time where the market goes down as like really short. Our generation sort of grew up thinking, oh, you know, the market's down for a couple of months, just hold on, you know, and we always thought just buy the dip, right? It'll come back. Well, historically, there are periods of time where the market's down for, you know, 5, 7, 8, 9, 10 years if you look at one specific asset class. And so is it conceivable that stocks could have a period of time where they're down over a 10-year period or a 5-year period? Not only is it conceivable, it's likely, right? Historically, it happens.
Well,
The
it kind of
problem
has
is,
happened in the last decade in a way. I mean, it's been a
yeah,
very
but
flat
again,
market.
a broad diversified portfolio of equities over the last decade has done better than most people think. I mean, when you look at just the S&P 500, well, maybe that's only up 2 or 3% or whatever the number is. I haven't looked recently. But if you were broadly diversified, meaning emerging market stocks, you know, from a U.S. perspective, you had international stocks,
Of course,
you
yeah.
had some U.S. exposure. You know, you did a little bit better than people are running. But the point here is the dilemma is we never know when that period's going to come.
Yeah.
You know, in 2009, everybody was saying stocks are dead forever. I mean, and people were saying things like, I remember reading this, I will never own stocks again, right? They owned them in 2007 when the market was high. The market goes down 50, 60, you know, in some markets, 80%. They sell out because they can't take it anymore. This is a human behavior, right? Like, I can't take it. I sell out. And then I make statements like, I will never, ever buy stocks again. Now those same people, after a 200% rebound, are starting to say, you know, maybe I should stick my toes back in again.
I actually heard anecdotal evidence of this the other day from a retail-focused brokerage, and they're pounding on the doors to get in now, and they haven't really until just now. And I think something like 70% of all accounts from one of the bigger European brokerage, like retail accounts, they didn't only stop trading, they left, they closed their accounts. And just very recently now, after we topped and started, like we have all these headlines, the Dow records, all these things, they're slowly coming back, and at a very worst time. I mean, there's a lot of evidence for this, so I think you're spot on with what you're saying.
Well, and I think if I don't know if you can put that chart, the fear and greed one, the little
Yes.
wave sign up. I mean, I think it's just important for us to all understand that this is a natural human tendency.
Yes.
It's what we were going to do. Like if you set out to design a poor investor, you would create a human, right? It's just we tend to get excited on that first line on the way up. We get excited when things are going well. It's genetic. I mean, think about this. We are always are seeking after things more of what gives us pleasure or security, and we want to run away as fast as we can from things that cause us pain. Yeah, things that cause us pain. And so when you think about how that translates, and you know, sort of jokingly, if we weren't built that way, we would have been eaten by the saber-toothed tigers a long time ago, right? So sort of jokingly, I mean, how that applies to investment piece, that's phenomenal genetic behavior to keep us alive, survival, you know, to get away from tigers or bears where I'm from, right? But when you apply it to the investment world, it doesn't work. I mean, what it leads to is this behavior where everybody around you is suddenly excited. The news is good. When is the news good and when is everybody excited? Well, the news is good and everybody's excited right after the market's gone up.
Yeah.
Now, we don't know when it's going to go down, but we know that typically the excitement and everybody gets, you know, all excited and starts buying, and your neighbors are buying, and your evil brother-in-law is telling you how much money he's making, and your neighbor's buying a private island, and right about that time you say, oh, you know what, I'm missing out, I'm going to pile in just in time for the market. And I could give you real numbers on exactly how this works. In fact, let me just tell you real quickly. In 1999, right, 97, 98, 99, if you just pretend that first line going up labeled I was 97, 98, 99. The Nasdaq here in the States was up over 120%. The S&P 500 was up over 80%. And we were pouring money in. Let me give you the number real quick. The record for money going into stock mutual funds in 1 month, the record was 29 billion before this time. If you were to just point at that arrow that is labeled greed buy and just make that January of 2000, right after this huge run, and we could do this again in 2007. I could give you the numbers for that too. But right after this huge run, remember the record was 29 billion for 1 month. January of 2000, right after the huge run, we had 49 billion. February, which is the shortest month of the year, $54 billion. Compare that to the record, 29, right? 54 billion. And March, 39 billion. So we had 3 months in a row where we totally destroyed any previous record. And remember, the market high was March. So we were pouring money in just in time to get our collective heads taken off. And that's natural. It's because everybody else is doing it.
I wish I
right?
could say
It's
that
what we
these
do.
statistics surprise me, but it's, I mean, this is the most. I had to go look because what you said is perfectly explained, using the investment strategy of possibly the most, like, top 10 smartest person to ever have lived. This is a chart of the South Sea stock and Newton's investments in it. We don't know the exact timing of it. I don't know if you can see it here, but
Yeah, I can.
the South
You need
Sea
to send me
bubble.
that.
Yeah, the South Sea bubble. It's an I did a blog on it once, just for talking about human behavior, because when the smartest person who has ever lived can't do this, how can we even like expect to be able to? So what happens here is, and Newton invested correctly at the right time, early hype. So he was buying it sort of in the early days of Tesla. If you say this is Tesla, I think it about doubles, and he wisely sells, and then and then it kind of it goes in a Bitcoin fashion straight up. Newton's friends get rich, and then at about 700, which is seven times, or is about double the price of what he sold at, he re-enters right before the top, and at first it seems like a wise decision, and then he eventually exits around the place both where he exited previously and bought, and he's broke,
Yeah.
and he was famously very bitter about this. But it's just such a fantastic chart to show that between in the span of 6 months, 8 months, Newton just became a broke individual just by a single investment, because he didn't understand this, because he was an expert at one stage, but clearly he wasn't an expert on anything in life. So I think it's just a fascinating. I don't know if you've seen this chart before.
No, I haven't. You need to send that to me. And I think what's really important is that, right? And what's really interesting here is sort of the behavioral sort of cognitive bias that we have. It's really easy to see Newton's mistake, right? And then when I talk about it in broad terms, like 49 billion and 54 billion, well, what typically happens in our heads is we say, "Oh yeah, that's what my silly friend was doing."
Yeah.
What's really hard is to say, you know what, boy, I did that. I got excited about real estate in 2007. Is to recognize your own mistakes. And what the data shows is that if you're human and if you're normal like the rest of us, you are probably making this mistake. Now, that doesn't mean I actually know people who are the opposite. They get excited. I mean, Warren Buffett famously said the key to investing is to get greedy when everybody else is fearful, and fearful when everyone else is greedy. Now, Warren Buffett's that way. I know personally a couple of people that way. They get excited when everybody else is scared, but that's not normal. The normal tendency is to do just like what this Newton chart shows he did. And so the question becomes, what do we do about it? And so that, to me, that's the first step. It's like any recovery program, right? The first step is to recognize you have the problem, and then we build automated behavior. We try to automate good behavior, because if you try to willpower your way through this, you're not going to be able to do it. And so the automated sort of behavior is, right, build a portfolio, stick with it, rebalance, have an objective third party. I think a real financial planner, a member of the International Guild of Real Financial Planners, there to help keep you. But it could also be your wife or your father-in-law. You just write down, here's my investment process, put it in an envelope, and then write on the outside of it, open if ever tempted to change. And then make yourself talk to, like, let's use your father-in-law, for example. Write a note that says, "Dear father-in-law, if I'm ever tempted to change this, I've got to have a 1 hour meeting with you where I convince you of my logic." That's it. I mean, it's 1 hour. Like, how hard is that? All I have to do is convince you of the logical reasons for my decisions. So there you are, Newton. You're thinking about making a change. You're going to re-enter that, whatever the stock is. You're going to blow out of your diversified portfolio to buy Tesla. And you go to your father-in-law and he opens his envelope and says, "Oh, this is a pretty rational plan that you built when you were thinking clearly. Help me explain why it makes sense for you to blow out of this plan and buy Tesla." And now you have to talk through it. I found most of the time you get 10 minutes into it and you're like, never mind. I'll just stick with my plan.
Yeah.
So
It's a sexy
that's one
idea, but
idea.
yeah, I understand.
One idea of how to just automate good behavior. There's a whole bunch of them, but I think the first step is recognize, if left to your own devices, you are going to buy high and sell low, because that's what feels good.
Yeah, it really does. And the crowd always seems to move
Yeah.
like this. And I remember, I mean, I don't want to be too anecdotal about this, but I'm naturally very bearish towards real estate, and always have been. I don't know why. Most people have. Well, I do know why, because I was abroad studying during the recent boom in 2004 to 2007, and 2008, early 2008, I came back, and I remember talking to people. It's like, but why are you buying? And the guy said, no, but you buy, and then you have a special kind of property. And he was explaining to me that you have this like joint mortgage And no, it's that's not a problem. And everything in my head was like clicking because it didn't seem right that everyone's making money. How can it possibly be good if everyone's making money? And I was like an objective spectator because I wasn't taking part of this, and every single individual over 18 was taking part of this mania. It was kind of strange to watch that because had I not gone abroad, I would probably one of those guys.
Yeah. Yeah. It's, I mean, I know I've made my mistakes and those for sure
Can I ask
I
what the worst one
remind,
is?
pardon?
Can I ask what the worst one is that you're willing to fess up?
Oh yeah, I have no problem with that. I mean I mean there's some funny ones, but you asked for the worst one. The worst one I wrote about it in the New York Times. It was a cover story for the business section, full picture of me standing in front of my house with the caption which I wrote that said I should have known better. And it was the story of me buying into the Las Vegas real estate market where we lived. And Vegas, you know, was maybe like ground zero of this you know, huge run and then giant crash. Maybe Florida, Phoenix, maybe, but Vegas was certainly among the top three. We lived there at the time. And we went through this experience where we're like, we moved down there in 2004, and the market had already, like every house we looked at, I knew had already doubled in price. So I was like, forget it, there's no way. And so we leased a house. And 6 months into our lease, my wife and I both were like, man, we better buy something or else we're never going to be able to afford it. There was this sort of palpable sense that the train was leaving the station and you better get on it. And so we did. And we bought a house that had already doubled in price and it doubled from there. I mean, we went from, you know, 500,000 roughly, and I've written about this in the New York Times, so I don't have any problem sharing it. It's over, they say over 1 million people read this story, which made my wife really happy. But the, you know, our house, I think we paid 575. There was a time when we could have sold it for 1,200,000, 2 years later. Our neighbors bought the house right next door to a same house, same floor plan, everything for 1,200,000. And I remember saying, hey, you know, we could probably put this in the newspaper, like a full page ad and sell it in a day for 1,200,000. And we're like, but then where would we move, right? It's our house, like all those stories you tell yourself. And we watched
But
that go
can you
from,
say more? How did that feel? Because that's
oh,
interesting. With your perspective, it's like emotionally, were you like ecstatic? Did you feel high? How does
oh,
that
it
feel?
was brutal. I mean, it brutal in the sense that you're like, wow, this is amazing, but there was always this sense in my stomach that like, wow, someday this is going to turn. But you know, you didn't want to be the person. Look, I am very open about this. This was a huge mistake, first of all. But I think being open about it allows other people to sort of see it. There's a sense like you're at the party and you don't want to be the person that says, hey, you know, maybe we should turn the music off, right? You don't want to be that person. You don't want to admit that the party's ever going to end. And
Yeah,
so, you know, like it was, and down there it was like, I mean, in Vegas, it was palpable. I mean, you could feel it in the air.
yeah.
And so, seriously, before I even could kind of wake up and figure out what was going on, our house was worth 475. And there were some major problems in there because I borrowed against my house to open my business when I left a
Oh,
big brokerage firm. So we owed way more than what it was worth. And so going through that process was I mean, you know, I don't use this term lightly, but it was the darkest time in my life, and it made me physically sick. I mean, I was physically sick a couple of times a month to the point where you know, anyway, we don't need to go into detail,
no,
but
I think it's actually. I mean, it's a very personal story, but I think it's also. I know people who give financial advice either on. I'm not going to specify where, but let's just say I know them, and people who tell other people what to do, and I know that they're. I can give you several examples of people who are publicly giving advice who have no control over their own over their own finances, and it's so refreshing that you're able to come in and you can say that okay, this is the point where I was ecstatic, but kind of there was something. It's like doing drugs. I don't do drugs, but I'm assuming that upon doing drugs there's this like moment where should I really be feeling this happy? It's not
yeah.
natural to feel this happy, so there's got to be a hangover afterwards. And I mean, you must have known that.
No,
deep
no, there was
diving.
always a pit. It used to be something I mean, I had a couple of friends that I rode road bikes with that we on out on our bike rides, we'd talk about it like, oh, and then we'd sort of talk ourselves into the idea, oh no, it'll be fine, it'll be fine. But there was always sort of a pit in your stomach. And I think the important lesson here, like we could talk a long time about what it felt like at the bottom. I could tell you about the experience of, I remember one night sitting, we had this big window that looked out in the backyard, and inside the window was where the family dining room table was. And I remember one night I was out, it was late, I got home late, and I had to walk out to the backyard for something, I can't remember why. And I remember looking in the window at my family eating dinner and thinking to myself, wow, I want to be back. I mean, it was so emotional that this is sort of on the way down now. So emotional that I felt totally disconnected with my family. Like I'd be at work all the time. I'd stay up at night waiting to see, how Europe opened and how,
Oh wow.
all of those how Asia opened, and hoping that there would just be some reprieve and all those feelings of like, and so I know what it means to feel sort of the crazy mix of money and emotion. And I also know that I can tell you my clients didn't know anything about this. And all of them, when they found out, because obviously they found out because I wrote this huge cover story for the New York Times, the phone call I got most often was, Carl, I wish we had known. And here you were giving us this great advice and helping us stay, steady and on the path while suffering through this yourself. And so the lesson there is, because people are often surprised when I say financial advisors should have a financial advisor, right? The lesson there is,
It's like a shrink going to a shrink.
yeah, you can't be an objective third party for
No,
yourself.
that's right. Because that's the
Yeah.
whole point of this profession, is that this is too hard to do yourself. And because for me to give advice to other people, everyone loves that. And it's so easy. And I can look objectively, I can pinpoint the problem, and it's like, no, you just do this, this, and that. What's the problem? And I'm looking at myself, and it's like, it's very hard to do these things yourself. And it's very easy to have an objective third party come in and just lay the law down. That's kind
No,
of your job.
it's almost impossible to see the mistakes in our own behavior because they're blind spots. You can't see them. And it's really, really easy for someone else to see them. And so that's what this relationship's all about. It's not about intelligence. I mean, to some degree, you got to know how to use a calculator, right? But other than that, it's not necessarily about you. The reason I tell everybody they should hire a really good financial advisor. Now, finding one, that's a whole nother discussion, but they're out there. But I tell everybody they should have one is not because you're not smart enough to do it on your own. It's not because you don't have time to do it on your own. It's all the information's out there. The problem is you can't remain objective about your own life. And so I often say that I could invest my own money except for the I part. And so my experience
That this
was,
is a very interesting point you're bringing up here. Can you
yeah.
can you make this into a product somehow? I'm
Yeah,
serious.
it's hard. I mean, that I think this is the dilemma with financial advice is most of the people who've made some money and need advice on how to invest it have been successful, right? By definition, they've been
Yeah.
successful. Unless I mean, they inherited the money, then they sort of feel born smart. But if you have money, you've probably done something right or gotten really lucky, and you don't understand why you would need somebody else to tell you how to do something as simple as invest it. Because investing's it's really simple, not to be confused with easy, but it's pretty darn simple, like what we actually do for people. But it's the reason you have someone there is not because you're not smart enough. It's because there's going to be a time. I think it's once every 3 to 5 years, but it could be more or less often depending on your circumstances. There's going to be a time where you're going to want to jump, and you're going to need somebody to walk you in off the ledge and say, hey, whoa, whoa, whoa. When we were thinking rationally, remember this plan we built? Let's stick with it. Now's not the time to sell. When the market comes back up, we can revisit the plan, and maybe we need to make things more conservative. But don't jump out of the life raft into the water right now. Right? Let's talk again when we get back on the ship.
Yeah.
That's why you hire someone.
That's a great way to put it actually. And no, it's truly eye-opening. I knew where you're coming from is an original place, but that backstory actually that explains because it's like you have this emotional. So like Newton, for instance, he hated investments his whole life due to this story. And I think that that story probably defined who you are. I don't know what you did at your previous job, but it was probably not as focused as what you do now. And writing for the New York Times, you wrote a bestseller, didn't you?
Yeah, the book. I mean, it depends on how you. There's a million ways to define a bestseller,
Can
but
you
the
just say
book
bestseller?
was
Just say
a
bestseller, and
business.
it's a bestseller.
Yeah, I know. I'm careful about that stuff. I actually care. It was a Business Week bestseller, but
Then it's a
the
bestseller.
book did really well.
Yeah. So I mean, you came, but it's kind of that it defines you. It's like Newton took this lesson and became bitter, because I think that he also it's also an important side point that I always, because talking to doctors is always it's always a peculiar thing, because doctors are almost universally smart people. So if you're universally smart and you're often quite right in areas where people normally don't have so much skill. So when you deal in medical issues, there's no absolute authority, and then a doctor comes in the room and he just gives but it's often a opinion, but still it's very, it's a lot of years of training behind this, and there's clearly skill there. And you put that guy in front of a computer and say trade, and this kind of embedded sort of confidence comes with it. And I think that's incredibly dangerous, because a person like that probably is less humble. And I think humility is probably the one thing you really need to successfully trade, manage money, create some balanced plan. Or what do you think about that?
Well, yeah, I mean, doctors are always sort of the easy ones to pick on, but I think it's any highly skilled professional has that the things that made them successful in their profession work against them when it comes to their money. And let's use another example real quick, because it's kind of I like it even better than doctors is entrepreneurs. You know, you think, or a business executive. Think about this for a second. If you're a business executive running a business, and let's just say it has two divisions. This is business 101. Like, you know, the first class you take, you'd be taught how to address this. So it has two divisions. One is doing really well, and one is doing really poorly. What you're taught to do is you kill the one that's doing really poorly, and you take all the resources and you devote it to the one that's doing really well. I mean, that makes sense in a business environment. Think about how, you know, how um, how terrible. I don't even know what the right word is. How that would be a disaster. Sorry, how disastrous that would be in your investment plan. What that sounds like to me is, okay, I've got one mutual fund that is technology stocks in 99, and I've got another one that's just plain, you know, my bonds. We could just do stocks versus bonds.
Yeah.
Stock market's going crazy. What that would say to me is, I'm going to take all the money from the bond market and move it to the stock market. That sounds like selling low and buying high. It makes sense in business. You know, get rid of that division, devote all the resources to the successful one.
Yeah.
But that would work against you in the investment world. So I think we could go through anything. But I agree. One of the biggest dilemmas is overconfidence.
Yeah.
And overconfidence is a problem you get. It's a problem of experts, right? It's what you would expect from an expert to behave. The dilemma is, once you cross that line, you suddenly become like, you're not even considering the possibility that you're wrong, and then you wake up one day and you were wrong, and it's had, you know, a disastrous impact on your financial life.
Have you ever been a trader?
Well, I've sort of fancied myself once, you know, like I used to think like, oh, I could do this, and there isn't. I don't think there's a trading. Well, I'm sure there are. I used to feel like there weren't trading strategies out there that I haven't researched, and I haven't found anything that I feel like has a high probability of success over time.
No, of course, and but I think that was the reason why I asked the question is, I think it's very fascinating to look at how traders view the world, because it's almost unique in any highly skilled profession, as far as I can pinpoint. a trader is the most humble. A successful trader is
A
extremely
good one,
humble.
sure.
What?
A good one, yeah.
Yeah, a successful one, meaning that you have a high risk-adjusted return year over year. So let's say George Soros, for instance. George Soros is famous for having no convictions in dropping a trade. So if he's in the Financial Times, this is something you have to remember when you read the George Soros quote. If he's in the Financial Times and they say, "What do you trade?" and he will share, sometimes he shares it, and he will say, "I am long euro against the dollar." And then he goes back to the office, and Financial Times is about to be published, and he sees something that affects that trade. He will flip it and probably do the opposite, or at least this, stop out of it. If he doesn't like it, he doesn't care about his emotional conviction. And I think a lot of people have a very deep emotional conviction towards being right. And I always respected that trait where you're able to just completely step away from sort of your let's say your masculinity or this like need to be right. So that's kind of why I think you could probably be a pretty good trader if you tried.
Yeah, yeah, yeah. Well, but I think that same stuff applies to just being a good, excuse me, a good long-term investor. Is realizing, you know what, the odds are kind of stacked against you, in terms of, finding some strategy. Most mutual fund managers, most hedge fund managers underperform the index. So why don't I just accept the fact that by getting the average, I'm actually going to be ahead of 90% of the population, especially if I behave correctly. And so what that leads me to think is like this is one area in life where doing less actually rewards you. And so I can now take that area of my life, build a diversified plan, make sure that it's operating correctly, have my advisor there to walk me in off the ledge when I get emotional, and then I really can kind of ignore it. I don't know what the market did. I mean, I got an email the other day saying, "Did you, somebody joking with me, like, did you sell out of the market today?" And I replied and said, "Why are you asking?" Like, well, don't you know the market was down? I was like, I guess I missed a correction because I was a 2 day correction because I was busy living my life. Like that to me is the benefit of this kind of
I
investing.
actually really like that. In my new venture, this very recently started web TV thing, I have to watch markets closer than I've done for years. But
Sure.
it was extremely rewarding in the 6 months leading up to this, and just working around the clock to fix to basically acquire a new skill and equipment and all this setup things. And for about 6 months, I had no clue what the markets did. And sometimes I would look at my terminal as, ugh, but and this who cares? And the worst thing I think is macroeconomic numbers, which, like when you were in your housing rut, which I trust is in your past now,
Yeah.
uh, and you were worried. You were watching non-farm payroll projections. You were probably reading 15, 20 articles, just praying and hoping. And you have a picture. I don't think I have it in the roll that's scrolling, but you had a picture there of something like hope and an investment or something like this, like overlapping a Venn diagram.
Yeah, I think it was
Uh,
buy and hope, and it said
yeah.
not an investment strategy.
It's and that's, I mean, in my country, that's that's how people invest. And the one question you get is, are you bullish or are you bearish? But yeah, but that's not the mindset.
Yeah.
You don't think like that. It's much more complicated than that. And like an asset manager friend of mine said, it's like you don't go into a doctor's office and say, "I'm going to do the surgery now." Just step aside. I got this.
Yeah.
And that it is a profession. Like I don't know how much experience you have and education in total. How many years would you say you have?
Well, we're going on 18, and I've got my certified financial planning designation. My degrees in finance. I got a couple other professional designations that I've since dropped, but I mean, there's a lot. I believe there's a lot that goes into this business, a lot. And if you take it seriously, that's one thing that I think really distinguishes members of the International Guild of Real Financial Advisors is, and again, this isn't like a formal organization, but one thing that distinguishes them is that, look, you take this as a profession, you're committed to ongoing education and learning and being on top of it, reading history as well, right? Like just really understanding it's serious business.
I just did my calculation now while of the numbers you gave, and I'm pretty sure you're well above the Malcolm Gladwell 10,000 hour mark. And that was kind of my point here. It actually takes 10,000 hours. I mean, you want to play chess, it probably takes more. You want to do downhill skiing, you got to lift weights, but you got to do it again and again and again and again. And you have to make mistakes, and you have to make like your horrible mistake, which was about in midway in your career, or even in the later third of your career up until now. So
Yep.
I think that that's what you pay for, and it is a real profession. And so many people don't respect it because you're ultimately either buying or selling, and it's a few clicks and it takes 2 minutes.
Well, and I think the other problem is there's so many people masquerading
Yeah.
as financial advisors. Like there's so many people that aren't anything more than sales folks, totally conflicted. And again, here's the dilemma, right? Like if I work at a big brokerage firm, there are real financial advisors that work for big brokerage firms. To be clear, it's not necessarily where you work, but there's an inherent conflict because my job may be to maximize the profit of my company, right? Not necessarily to help you. Now, hopefully those are aligned. I think more and more the big firms are understanding that if you want to be in business long term, you better make sure that your focus is on helping the client reach their goals,
Yeah.
not necessarily you maximizing profit in the short term. But the point's still valid. There are plenty of people in this industry that really aren't concerned at all, independent of where they work. So let me just be clear about this. I don't want anybody to confuse that I'm saying the people at the big brokerage firms are stealing. That's not what I'm saying. I want to be clear. No matter where somebody works, there are plenty of people in this industry that aren't at all concerned about you and your goals. They're
Yeah.
mostly concerned about them and their revenue, making their
But
mortgage
you're
payment,
not
buying their
willing to say
boats.
it. I'm kind of willing to say it, to be honest. If you're trusting a broker, I think you're putting your trust in the wrong person. And having spent a lot of time with brokers, I mean, that's maybe not who you want to deal with, because a lot of these industries are rigged against the customer. And the brokerage business is probably more than anyone else. But I understand you don't want to accuse the whole industry, but you have to just look at their incentives. Their incentives are to rip and run, and that's it.
Yeah. Yeah. Well, and my dilemma I agree with you. My dilemma, the reason I'm careful is I have friends that work for brokerage firms that I would send my mother to.
Yeah.
They're that good. They're not, but they aren't a broker, right? They're a financial advisor that happens to work at a brokerage firm. I also know people that are independent financial advisors that are stealing people's money. You know what I mean? Not literally, but so I think that's why this industry is so problematic. Is there isn't one set standard. I mean, I would say to you, I think you get a long ways by hiring somebody who's got a certified financial planning designation. I think you get a long ways by hiring an independent financial advisor. I think somebody who's willing to say that they act as a fiduciary. Those three things, it doesn't exclude anybody, but it at least helps narrow the field, I think, by just looking at least those three things.
Yeah. And do you think we have to? I mean, I think I could talk to you for quite a long time
But
now.
we'll just do it. We'll just do it another time.
Yeah, for sure. We have to do this a little bit regularly. But I'm trying to cap off. But I have one last question. Do you think that the problem there is, it's like a two-part, I guess. The problem is that responsible wealth management or buying bonds or whatever, it's kind of dull. It's not very exciting. And then you have this like fast-paced, fast-moving, Apple is down 8% today kind of a market where you can double your money in 3 hours, or you can lose everything. That's been cultivated on the CNBCs of the world for so long. Or look at Business Insider. I mean, the market is down 1%, and they're having an illustration of this airplane dropping dropping water on. I mean, it's such a dramatic demonstration, and I literally remember news sites from 2008 that put blood on pictures because there's blood on the street, and you're so literal minded that it's blood, it's actual blood.
Right.
And do you think that this kind of mentality has driven that this like sensible modeling that what used to be finance, what used to be the brokerage business back in the day when you had partnerships and people were much more responsible, careful with risk. Do you think that that it's possible to regain some of that when everything is so fast paced and so kind of so sexy, and you have this like idiots like Jim Cramer just hitting buttons and turning this into a game when it's clearly not a game, and it's so important.
Yeah, I don't. All I know is there seems to be a growing. I'm hoping there's a growing group of real financial advisors out there. The problem is they are boring. And so to keep clients from understanding, like that's the dilemma is we're always, and I shouldn't say clients, we as human beings, me, I'm always distracted. Like, wow, look at that shiny, happy thing. That looks like a lot of fun. Shouldn't we be? So every 6 months or so, I go down that same rabbit hole where I say, all right, it's about time. Am I sure there's no better way to, right? And so I'll go on a research project and I'll get to the bottom and I'll be like, you know what? I'm but the dilemma is when this is, we just have to get people a growing awareness to understand financial pornography is not helpful, right? CNBC, just to pick on them, I mean, there's a million
Oh,
outlets for
please
this
do,
now,
please
right?
do.
But the Financial Pornography Network does not help you. That's entertainment. You know, circus clowns are entertaining too. But you shouldn't take investment advice from circus clowns. And so I think it would be important for you to understand the difference between entertainment and investing. Now, trading, if you're a trader, well, then maybe you have to have CNBC on in your office to know what's going on all the time
No,
because that's
no.
what you, but
they're,
it's
they're
still going to
catering to
destroy
no one.
you.
That's the weird thing. Why are they hitting buttons? I mean, it's not that entertaining. So if I want to be entertained, I watch The Sopranos or something, which is actually like this like fantasy world which has no ramification on my personal wealth. Actually, maybe like when you watch Three Sopranos, you kind of feel like Tony Soprano a little bit, but that's beside the point. But I think your a circus clown is a good way uh, of good way of sort of assessing it. But I think that I mean we see that people watch less and less of this, but and I do think guys like you are actually able to bridge the gap because you're not dull, and these pictures, and I have them cycling down in the bottom, and I'm buying one for the office space here where you can buy a digital file and print it yourself because I think this is like it's so simple and it's so beautiful, and this is like corporate art that's worth having. And I think that some guys like you and Josh Brown is another notable one,
Yeah.
and a few other Barry Ritholtz and a few other that have managed to make this incredibly dull subject about being responsible actually quite entertaining without
Yeah, well,
dumbing it
yeah,
down.
I love Josh and Barry's stuff, and thanks for the kind words about the art. I think the important thing for people to understand is, you know, is just like what I'm trying to do is just give people permission to let go of the need to just realize that, because you're right, I don't think very many people find that stuff entertaining, but they're watching it because there is a sort of a well-intentioned feeling of like, I got to be watching this. I got to be reading this. I got to be on top of this because this is what you do as an investor, isn't it? And I care about my kids' college education fund and like it's this real sense of anxiety. And it's misplaced. That's the thing we're trying to help people understand is you don't need to do that. It's actually that's what the behavior gaps for me, it's what's it's come to mean is well-intentioned behavior that we thought was bringing us results that's actually hurting us. That anything so what I'm telling you is watching all that stuff, keeping on top of it. Your Forbes, whatever, your Smart Money, Money Magazine subscription. There's really useful stuff in there, but I'm trying to give permission to let it go. Right? Let go of it. You don't need. It's not helping you. It's actually hurting you. And so if you understand that, I could fill them with books is going to actually help you more. And doesn't it sound better? That's what I'm trying. We're trying to give people permission to believe us, right? That's the deal.
Yeah. And I think it's a beautiful sentiment. And to end, I want to advertise your some of your drawings you can get, and I'm just putting up my computer here, and it's there's so many good ones, and I think that this is. Can you tell us a little bit about the style? Where did you come up with this style? Because it's a very clean, but yet I mean it's quite artsy. Do you actually do it, or do you have somebody polish it up, or?
No, those are all literally, I mean, I'm staring over at, there's a desk I have a Sharpie which is just
No.
a felt marker for those people who don't know, a Sharpie and big giant stack of cardstock paper and a Fujitsu scanner. And I'm only
Wow.
emphasizing that because there's like nothing romantic about it. There's not light coming in or angels singing. I just literally sit down and say, okay, how could I illustrate this one issue? And I really work hard. It's interesting to see some of the progression of stuff. I really work hard, and I think I'm getting better at it,
Yeah.
at removing anything that doesn't matter. So I don't feel like I'm done until there's nothing left to take away from the illustration and still capture the point. And so I didn't know I had a style until a couple of years ago. I mean, I've now done a couple solo art shows, one here, one in London, one in Belgium. People buy this stuff and hang it on their wall. Be
Oh,
careful!
I'm gonna buy it. Now I
Don't show
found
that
the
Jim
one I'm
Kramer
gonna
one.
buy.
Be
This
careful.
is the one I'm gonna buy.
That's the only image that I actually almost universally get a standing ovation for
Oh wow.
presentation.
Wow.
So, and one thing I'll mention on the website while you're there is
This is
we
brilliant.
do a weekly newsletter that
Yeah.
that would be the one thing that might be valuable to your viewers is the weekly newsletter. It comes out every Thursday. It's about an image, and it's obviously
Yeah, I
free.
got
So
my
you
first
sign
one
up on the
now.
website.
That's it's an easy. I only get two newsletters, yours and Benedict Evans, and both
Well,
are
thank you.
equally good in different ways. So yeah, I think that's a good place to end it at, and I want to thank you for taking time to be part of our first interview show. So it's gonna get some momentum eventually, and we had a little bit of viewers now, and hopefully you thought it was okay.
Yeah, it was fantastic. Thanks for having me.
Thank you, and we talked for over an hour, so I think it's
Look
about
at
time
that.
to
Yeah.
turn up. And we're gonna be doing a lot of interviews like this. Anything from we actually have a psychopath lined up, and a couple of another one that people think is a psycho. Actually, I don't know why there's nothing to do with you, but we have an actual literal psychopath lined up. So
Wow.
yeah, it's a deeply interesting topic. He also
Yeah.
studies psychopaths, incidentally.
Wow.
So no, and we have a bunch of finance people. Like we try to talk to big thinkers. So anyone who's got a big idea, it's fun to talk to because it almost always has some kind of connection with finance. So anyway, thanks for being with me. And the podcast of all our shows is going to be up probably tonight. So the first time you were able to download it. And we also have a basic newsletter like alerting people when we go live and sending out shows. So thanks
Okay.
so much, Card, for talking with us.
Are we done recording?
Uh, y- Not anymore. I'm turning off the